a stock beats earnings by every metric analyst predicted. Revenue up, profit up, guidance raised, and the price drops 8% the next morning. Retail traders call it irrational. Professional traders are not surprised at all because they read a signal 3 weeks earlier that told them this exact move was coming. That signal has nothing to do with the news. It is a language written entirely in price and volume, and almost nobody outside institutional trading desks is taught to read it. Today, inside the vault, we are learning that language from the man who wrote the book professional traders are tested on. John J. Murphy spent decades working at the highest levels of financial market analysis, serving as the technical analyst for CNBC, leading Merrill Lynch's Technical Analysis Futures Division, and earning the first-ever award for outstanding contribution to global technical analysis from the International Federation of Technical Analysts. His book, Technical Analysis of the Financial Markets, is not a trend-following paperback. It is the foundational text used by professionals, the Chartered Market Technician program, and serious traders who refuse to leave their decisions to emotion, rumor, or guesswork. This is the book that strips the mystery out of price behavior and replaces it with a systematic, visual, and extraordinarily powerful framework. By the time we reach the final section of this masterclass, two things will become unmistakably clear. The first is why most traders fail not because markets are random, but because they are reading a language they were never properly taught. The second is the exact one-sentence definition Murphy uses for the moment: a hope becomes a real trade, a definition most traders never learn until they have already lost money finding out the hard way. Subscribe to the Book Vault right now if you have not already, because we release strategic intelligence like this every week, and it is designed to give you a genuine, unfair advantage in every financial decision you make. The philosophy of technical analysis and Dow theory. We begin at the very foundation of everything this book teaches, and Murphy calls it the philosophy of technical analysis and Dow theory, rooted directly in the intellectual legacy of Charles Dow. Most people assume technical analysis is about reading lines on a chart and guessing which way price will move. That assumption is exactly why most people lose. Murphy opens with 3 premises that function less like trading rules and more like laws of financial nature. The first is that market action discounts everything. The second is that prices move in trends. The third is that history repeats itself. These are not opinions. They are the operating system beneath every profitable trade in history. The deeper layer most readers miss is why these 3 premises are so powerful together. The first premise tells you that every piece of information in the world, every earnings report, every geopolitical development, every rumor in a boardroom is already priced into the market before you ever hear about it. This idea alone should fundamentally change the way you approach investing. Most people react to news. Professionals watch what price does after news arrives. That behavioral distinction is the entire difference between consistently losing and consistently winning. Most traders think they're following the big trend. They're not. They're reacting to the smallest, most meaningless movement on the chart, the minor trend, and mistaking it for something real. Dow theory splits every market into 3 layers moving at once. The primary trend is the multi-month story. The secondary trend is the correction that tricks people into panicking. And the minor trend is just noise, daily static that convinces retail traders to buy tops and sell bottoms. Ask yourself right now, the trades you've made this year, were they based on the primary trend, or were you trading the noise the whole time? And this is where most people destroy their portfolio before they even realize it. They are trading the minor trend while believing they are trading the primary one. Murphy's framework for Dow theory requires that a trend remain in force until there is definitive evidence of a reversal, not a feeling, not a suspicion, evidence. This distinction between opinion and confirmation is the exact place where amateur thinking ends and professional trading begins. The question Murphy plants in your mind early in this book, one that will only fully resolve by the time we reach the final section, is this: what does confirmation actually look like in practice? The language of charts and trend. Murphy just told you a trend stays in force until proven otherwise, but proven how? That question has a precise answer, and it lives in the next chapter, the one Murphy calls the language of charts and trend. And this is the section every serious trader must master before touching an oscillator or a moving average. This is where the book becomes genuinely dangerous in the best possible way. Murphy defines an uptrend with surgical precision as a series of successively higher peaks and higher troughs. A downtrend is the mirror image. This structural definition, not a subjective visual impression, is the bedrock of everything that follows. Most traders eyeball a chart and call it an uptrend. Murphy demands rigorous structure. What comes next is the part of this book that most people never even reach, and it is where the real edge begins to separate itself from the noise. Murphy's treatment of support and resistance is the most thorough available in any introductory or intermediate text. The role reversal principle is particularly powerful. Prior support becomes resistance after a breakdown, and prior resistance becomes support after a breakout. This single concept, properly applied, eliminates dozens of bad trades every year because it tells you exactly where price is likely to pause, reverse, or accelerate before it happens. Here's what most people get backwards about channels. They think the lines predict the future. They don't. They reveal probability. Every time price touches the bottom of a rising channel, that's not a guarantee. It's a bet with better odds than the one you're making right now without any structure at all. And the traders who survive aren't the ones who are certain. They're the ones who think entirely in probabilities. Inside the vault, we call this the geometry of intent. Murphy shows that price does not move randomly. It moves in structured, measurable, repeatable ways that reflect the collective psychology of every buyer and seller in that market. The percentage retracement concept he introduces, where corrections tend to retrace predictable portions of the prior move, gives traders a map of where pullbacks are likely to end. That map is not perfect, but a trader with a map who acknowledges its imperfection is vastly more dangerous than a trader who is simply reacting with no framework at all. The next chapter explains why patterns are the fingerprints of market psychology. Price patterns, reversal, and continuation. We now enter the chapter titled Price Patterns, Reversal, and Continuation, and this is where Murphy shows that price patterns are not random shapes. They are the visual footprints of human psychological cycles playing out in real time. Murphy's breakdown of major reversal patterns begins with the most powerful of them all, the head and shoulders formation. This pattern appears at major market tops when buying power is exhausting itself. The left shoulder forms on strong volume, the head forms on slightly weaker volume, and the right shoulder, critically, forms on the weakest volume of all. Volume is confirming what price is whispering. The terrifying part is that most traders see the right shoulder forming and interpret it as a minor pullback in an ongoing uptrend. They add to positions right before the floor drops out. Murphy is unambiguous about what the head and shoulders pattern requires before it becomes actionable: a decisive break below the neckline, confirmed by a significant expansion of volume. Without that confirmation, the pattern is just a shape. With it, it becomes a high-probability, structural signal. This is where mainstream advice collapses. Popular trading content tells you to buy breakouts and sell breakdowns. Murphy teaches you the disciplined evidence required before any of that becomes rational. Continuation patterns tell a different story. Triangles, flags, and pennants are the resting formations of a trend, the moments where the market pauses to gather energy before resuming the dominant direction. Murphy distinguishes carefully between symmetrical triangles, which can resolve in either direction, ascending triangles, which tend to break to the upside, and descending triangles, which tend to break to the upside, and descending triangles, which favor downside resolution. The measuring technique Murphy attaches to each of these patterns, using the height of the pattern to project a price target after the breakout, gives traders not just a signal, but a destination. Most people know how to spot a breakout. Far fewer know how to measure where it is going. Most summaries skip this entirely. We will not. Murphy includes a critical warning inside this section that separates it from every generic pattern trading guide. He writes that the failure of a pattern is itself a powerful signal. When a head and shoulders forms and price breaks above the right shoulder instead of below the neckline, the pattern has failed. And a failed bearish pattern in a previously bearish context is often one of the most bullish signals a chart can generate. The market has absorbed every seller, tested their resolve, and rejected the breakdown. But here is the truth that separates professionals from amateurs more than any pattern. Even the clearest head and shoulders formation means nothing if volume is not confirming it. What comes next is the verification layer that tells you whether the chart is showing you a genuine signal or just a beautifully drawn trap. Volume, moving averages, and oscillators. We now step into the chapter Murphy calls volume, moving averages, and oscillators, and this is the section he considers the confirmation engine of the entire system. Volume, moving averages, and oscillators are not standalone indicators. They are the verification layer that tells you whether what the chart is showing is real or illusory. Murphy opens this pillar with a deceptively simple principle: volume should expand in the direction of the primary trend. In an uptrend, rising price on high volume is healthy. Rising price on declining volume is a warning that the move may be running out of participants willing to push it higher. And late at night, when the screen is dark and the position is open, a small voice comes, doesn't it? A voice that asks whether you can actually trust what the chart is showing you, whether you are seeing a genuine signal or just the market setting a trap. Murphy's answer is systematic. He builds a layered confirmation framework, moving averages, smooth price action, and defined trend direction. The golden cross, where a shorter-term average crosses above a longer-term average, is a widely cited bullish signal. But Murphy immediately warns that moving averages are lagging indicators by nature. They confirm what has happened. They do not predict what will happen. Used alone, they get you in late and out late. This is where oscillators enter as the counterbalance. Murphy covers momentum, the relative strength index, moving average convergence divergence, and stochastics with practitioner-level clarity. The key to oscillators, he explains, is understanding when they are most valuable and when they are most dangerous. In a trending market, oscillators generate misleading overbought and oversold readings because price can remain overbought for extended periods during a strong uptrend. Oscillators become most powerful during sideways, non-trending markets where overbought and oversold readings genuinely mark turning points. Using the wrong tool for the wrong market condition is one of the most common and costly mistakes in trading. The concept of divergence is where this pillar reaches its most powerful insight. When price makes a new high but an oscillator like RSI fails to confirm that new high, divergence is present. The price is lying. Or rather, the momentum behind the price is fading, even as the price itself extends higher. This divergence is one of the most reliable early warning signals of a trend reversal that technical analysis produces. Murphy shows this through chart after chart. The signal does not tell you the exact top. It tells you that the energy behind the trend is quietly dying, and the risk of holding long positions has increased dramatically. The next layer of this system operates at a scale that will reframe every trade you have ever made. Intermarket Analysis and the Connected Market. We now move into the chapter titled Intermarket Analysis and the Connected Market, and here's the insight this book quietly plants in your chest that most traders never allow themselves to fully accept. No market moves in isolation. This is the chapter Murphy builds toward when he introduces intermarket analysis, the framework that connects stocks, bonds, commodities, and currencies into a single, unified analytical picture. And this next realization is the exact moment everything splits into before and after. When bond prices fall, yields rise. Rising yields increase borrowing costs and create competition for capital that equity markets previously monopolized. The relationship between bonds and stocks is not a coincidence. It is a structural financial reality that repeats across decades. Murphy draws the connections precisely. Commodities and the dollar share an inverse relationship. A rising dollar typically suppresses commodity prices because most commodities are priced in dollars globally. When the dollar strengthens, it takes fewer dollars to buy the same barrel of oil or bushel of wheat. When it weakens, commodity prices tend to rise. This chain reaction moves through every asset class. A trader who only watches their individual stock or futures contract is operating with a dangerously incomplete picture. They are reading one sentence in a paragraph they do not know exists. The Vol perspective on this is different from what most market education teaches. Stop and think about your last losing trade. Was the chart wrong or was it right, and you were reading it in isolation from everything else moving around it? The practical application Murphy draws from intermarket analysis is sector rotation. In different phases of the economic cycle, capital flows from one sector to another in predictable patterns. Defensive sectors like utilities and consumer staples tend to lead in late-cycle environments when growth is decelerating. Cyclical sectors like materials and industrials tend to lead early in a recovery when growth is accelerating. Understanding where money is flowing, not just what a single stock is doing, is what separates market participants who understand the ecosystem from those who are simply guessing inside it. Most people listening right now are trading in one room without knowing the rest of the house exists. What happened inside Murphy's own analytical evolution was that he recognized a truth most traders resist. Every market is a mirror of every other market. Interest rates tell a story about inflation. Commodities tell a story about global growth. Currencies tell a story about relative economic strength. And stocks are the final recipient of all those signals, absorbing them and reflecting them back in price action. That thought feels overwhelming at first. But once you internalize it, you realize it also means you now have multiple independent confirmation signals available to you before you ever place a trade. But even with all of these analytical layers, no framework can protect you from the one thing that destroys more trading accounts than any bad call: yourself. The final chapter reveals the architecture that separates those who survive from those who don't: money management, trading systems, and the final checklist. We now enter the final chapter of the strategic breakdown, the one Murphy calls money management, trading systems, and the final checklist. By this point, a reader might feel they have already received a complete picture. They have the philosophy, the chart language, the patterns, the indicators, the intermarket connections. They believe they are ready to trade. But just when the blueprint feels finished, Murphy surfaces the one dimension that can nullify every other tool, and his response to that feeling of completion is blunt. A great analytical system without money management is a well-designed vehicle with no brakes. Murphy's money management framework begins with the principle that most trading courses bury or skip entirely. He writes that controlling the downside is the primary job of every trader, and that profits will take care of themselves if losses are managed properly. The reward-to-risk ratio framework he introduces demands that every trade have a clearly defined and predetermined exit point before it is entered. Not after the trade is open and emotions are engaged, before, because the moment a position is open, psychology distorts judgment. The plan must be made when the mind is clear and the market is not yet speaking to your ego. Here's the uncomfortable truth Murphy forces you to face. Most traders lose not because they lack a signal, they lose because they had one signal and called it enough. Murphy's checklist, 23 points long, exists because one confirmation is never enough. Trend, support, volume, intermarket context, oscillator alignment, all of it has to agree before your money should be at risk. Skip even 3 of these and you're not trading. You're guessing with extra steps. If you leave with nothing else from this video, let it be this. Murphy closes the book with a reminder that technical analysis is not a system for predicting the future. It is a system for managing probabilities in the present. The market will always produce surprises. The goal of every framework in this book is to ensure that when the surprise comes, your position size, your stop placement, and your exit plan have already accounted for the possibility of being wrong. The trader who survives long enough to be right consistently is not the one who is never wrong. It is the one who has structured every trade so that being wrong does not destroy them. Key lessons and insights. The market discounts everything before you know it. The first lesson this book permanently rewires into your thinking is Murphy's foundational premise that the market discounts everything. Price is not a lagging indicator of what is happening in the world. It is a real-time aggregation of every expectation, every fear, and every piece of information held by every participant simultaneously. By the time a headline reaches you, professional money has already acted on its anticipation of that headline weeks earlier. That is why a company can beat earnings and still drop the next morning. The event was already priced in, and the reaction you're watching is profit-taking, not surprise. Murphy's framework teaches you to watch what price does after news, not the news itself, replacing reactive trading with evidence-based discipline. Trend is the most powerful force in any market. The second lesson Murphy drives home is that trend is the single most powerful force in any market, and the job of every technical analyst is to align with it rather than fight it. A trader who buys a stock because it looks cheap in a confirmed downtrend isn't investing. They're arguing with the aggregate judgment of every buyer and seller in that market. The trend is more likely to continue than to reverse, and Murphy's hierarchy of timeframes, always read the larger timeframe first, filters out the enormous volume of false signals that trap traders operating without this structural lens. Confirmation protects capital more than conviction does. The third lesson quietly challenges the ego of every ambitious trader. Confirmation protects capital more than conviction ever will. No single indicator, pattern, or signal is sufficient to justify risking real money. Murphy's framework requires multiple layers of agreement: price, volume, pattern structure, intermarket context, before a trade earns its place in a portfolio. Conviction is what gets people to open a trading account. Confirmation is what keeps them in the game long enough to build real wealth. Divergence is the market whispering before it shouts. The fourth lesson is one of the most operationally valuable insights in the book. Divergence between price and momentum is the market whispering a warning before it shouts a reversal. When price makes a new high while RSI makes a lower high, price is pushing while momentum is fading, and the small observer minority watching momentum is usually right. Every sustainable trend needs increasing participation. When that fades, the trend doesn't reverse immediately. It slows and shows divergence first, giving a prepared trader time to tighten stops before price itself cracks. Intermarket context determines whether your signal is real. The fifth lesson synthesizes everything into one principle. Intermarket context determines whether any individual technical signal is working for you or against you. A bullish breakout means something very different when bond yields are rising, the dollar is strengthening, and commodities are collapsing than it does when those signals confirm a risk-on environment. The individual chart tells you what one market is doing. Intermarket context tells you whether the environment supports that signal at all, and internalizing that is what produces the most durable improvement in trading performance. The vol closing, you now have the philosophy, the chart language, the patterns, the indicators, the connections between markets. If you stopped here, you'd already know more than most people who call themselves traders. But Murphy doesn't let you stop here, because he knows the one thing that has destroyed more accounts than any bad signal ever has. Not the market, you. Here is the one specific action you can take within the next 7 days. Open the longest-term chart available for any market you follow, whether that is a weekly stock chart, a monthly index, or a long-term commodity chart. Before you do anything else, answer 3 questions that Murphy's system demands. What is the primary trend direction on this chart? Where are the key support and resistance levels? And is the most recent price action confirming or contradicting the primary trend? Do not trade, do not research earnings, do not read analyst opinions until those 3 questions are answered from the chart alone. That exercise will immediately reveal whether your current understanding of that market is based on evidence or assumption. And that brings us to the second insight we promised at the start, the one about the moment a trade actually becomes a trade. Murphy's answer, assembled across his final chapter, is that a trade becomes real not when you enter it, but when you have already defined where you will exit if you are wrong. The moment that stop is set, the risk is accepted, and the plan is in place. That is when a gamble becomes a trade. Everything before that is hope. A trade becomes real the moment you define where you're wrong. This is the insight most traders never absorb, and it is the one that separates those who survive long enough to prosper from those who don't. So here's the real question. Not what will you trade next, but where will you be wrong, and have you written it down before you click buy? If this masterclass gave you a real edge today, hit subscribe, because we break down one book like this every single week. And before you go, tell us in the comments, which signal do you miss most often, volume or divergence? You are not here by accident, neither are we.